this on-demand video, OJM Group Partner Andrew Taylor explains the sequence of returns risk and offers strategies to mitigate this risk to protect your retirement savings. If you have more questions or want to learn how to incorporate retirement planning into your financial strategy, click the link below to schedule a complimentary one-on-one consultation with one of our experienced team members.
Thank you for tuning in. My name is Andrew Taylor, partner and wealth advisor at OJM Group. So topics pertaining to sequence of return risk and items that us today. First of all, what is sequence of return risk? Why is it a concern for investors, and when is it applicable? The answer is it's applicable for anyone investing for a specific goal or a specific time frame, most commonly relevant to the period of retirement and why you should begin to mitigate some sequence of return risk in the period of time prior to retirement. Generally, that'll be a 3 to 5 year time frame. How can the risk be managed? We'll address some of the challenges in shifting investor focus from a goal of maximizing returns to suddenly one of risk mitigation. I mean, this is particularly difficult given you've been in the accumulation phase for 30, 40 years of your working career, and now suddenly achieving maximum results is no longer the priority. The priority needs to be mitigating risk and limiting downside. It is a shift in mindset simply because now you need to enter a period where you're going to accept lower returns by adding these vehicles to limit the downside. And that's not a natural transition for any investor, frankly, if you haven't practiced risk management in a prior period during your investment career. And then we're also going to provide you with some supporting data, which will show the value of limiting risk and why it is critical as you approach the period of time where you need to access cash flow. So sequence return risk, what exactly is it? Well, it's the danger that the timing of the liquidation of assets and the withdrawal from a retirement account will coincide with a downturn in the market. And again, this doesn't have to be specific to retirement accounts, but if you're saving for a vehicle purchase, home purchase, college education, any other lump sum investment, sequence of return risk is indeed very relevant. So you effectively, what will happen is you'll reduce the overall upside potential and performance of the portfolio by implementing these strategies. And the need to liquidate essentially during a down market will force you to sell a larger number of shares to generate that necessary cash flow to support your expenses. Naturally, what that means is fewer shares are left in the portfolio to grow and accumulate, and mitigating the sequence of return risk is the number one factor that determines success or failure as it relates to a retirement outcome for those who have saved adequate dollars towards retirement. So the best way to illustrate and dive into the importance of mitigating sequence of return risk is to just give you a real life example. So we used round numbers for simplistic purposes. So you see a portfolio in front of you, $100,000 supporting a 25-year retirement horizon. Now, the withdrawals are $5,000 per year. Obviously, that's a 5% rate of withdrawal. So that's certainly pushing the envelope of what would be considered a sustainable rate. A range in the area of 4% is generally accepted as being suitable. So 5% will certainly put strain on any portfolio. But in looking at the returns, Portfolio A and Portfolio B, what you will notice if you take your eyes to the right-hand corner, the average return for these two portfolios are exactly the same at 6.8%. The difference between the two portfolios is Portfolio A had a negative outcome, in the early years, and then Portfolio B had a positive outcome with strong market returns in the early years of the retirement phase, or the distribution phase, I should say. Now, the issue is as you have negative years and you're putting strain on the portfolio, it creates a problem. And portfolio A ran out of money by year 20, whereas portfolio B, even though they had the same returns, same withdrawal rate, more than doubled their money. So successful outcome for portfolio B, a matter of good fortune, not necessarily of any successful strategy that had been implemented. So here's another way to look at that before we dive into some of the ways that you can mitigate the risk. Portfolio A, if you look, the gray line is simply the balance of the portfolio, and then the blue line indicates the market returns of said portfolio. Now, the reason why portfolio A ran out of money, suddenly the rate of withdrawal is significantly larger than 5%, by years 2 and 3. And if you're taking an 8-9% rate of withdrawal, the outcome is not going to be successful in terms of sustainability. Portfolio B was fortunate that the positive years occurred early. The ultimate outcome meant that the rate of withdrawal was drastically lower than 5% because of the growth in the portfolio. So it was able to sustain several negative years towards the end of the retirement cycle. Now, hearing this data, you may be somewhat distraught because the return stream, is somewhat out of your hands, or you can't necessarily have an influence on whether there are positive market returns when you retire or negative market returns in the sequence of those returns. So how do you manage sequence return risk? That's really the question. Well, first you want to understand what's the likelihood of losing money. And what's in front of you are represents the likelihood of losing money when investing in the S&P 500. Now, S&P 500 is obviously an equity index. It's cap weighted. It's the 500 largest stocks in the U.S. So there's no risk management in place here. Obviously, no bonds, no cash equivalents. So an all stock strategy is going to lose money essentially 1 out of every 4 years. So you have positive returns 73% of the time, or nearly 3 out of every 4 years. So what this information tells you is you want to start the risk mitigation process prior to retirement. And ideally, that's in a 3 to 5 year period, because if you do have an all equity portfolio, odds are you're going to be losing money within the first 3 years of your retirement. So start that risk mitigation process prior to either retirement or the period of time where you need to start taking cash flow. Allow time to work to your benefit. As you can see, in a 3 year period, the odds of losing money, again, in an all stock portfolio, is only 16%. And over a 5 year period, it's only 12%. Well, if we were to add bonds or some risk mitigators, you're going to see the odds of losing money drop drastically. So what we shared for you for the purpose of this discussion was just simply the odds of losing money in an all equity portfolio. If we get a little more specific in terms of real life examples, I'm showing my age here, but 2008, the S&P lost 55% in a period of 18 months, and this was during the financial crisis. Investors who had an all stock portfolio took 3.5 years for them to make their money back. However, during that same period of time, someone with a 60-40 portfolio, 60% stocks, 40% bonds, were able to recover their losses in a period of 18 months. So what they had done is they bought themselves time to allow their stock losses to recover, and were able to liquidate bonds to manage downside risk. So transitioning to a more conservative portfolio, here's some factors to consider when implementing that process. So you'll have to ask yourself, what is your anticipated retirement age, and how many years of retirement are you reasonably expected to fund? Now, no one knows their exact life expectancy, of course. You can look at family history, look at the state of your current health, and then how many years of your retirement are you going to need to support? So, if you retire early at age 55, you could be looking at, a 35-year, 40-year time horizon that your portfolio will need to support versus, if you retire at age 70 and don't necessarily have a lengthy life expectancy based on family history, you may only be supporting a 15 to 20-year retirement period, and you need to generate cash flow for that equivalent time horizon. Do you have alternative sources of income? If you have a pension, if you have a cash balance plan, or let's say you own your medical office building, you don't have to sell it, that creates recurring revenue or recurring income for you. Your dependence upon the portfolio may be significantly less, and therefore the need to mitigate sequence of return risk might be a little less versus someone who is taking a larger percentage of their investable assets, something in that 4 or approaching the 5% range. Individuals in that category certainly need to get more conservative and limit the downside to have a successful retirement outcome. Another factor that you need to ask yourself, will you be emotionally prepared to experience large fluctuations in your net worth when you're no longer receiving a regular paycheck? So if the majority of your cash flow is supported by your investment portfolio, you may experience a lot more anxiety when you're seeing fluctuations in the value of that portfolio. I mean, particularly if you've accumulated, several $1,000,000, you will see $100,000 swings in the value of your accounts. It may not bother you when you know you have additional earning power, but when you're no longer getting that recurring paycheck and you're relying on that portfolio to generate your cash flow, it can be a very emotional experience to see the accounts fluctuate in value. Best way to mitigate that volatility is add these vehicles to the risk, such as fixed income, cash, and cash equivalents. And then final factor for you to consider, and ask yourself, what is the makeup of your assets, and will a liquidation of equities create a significant taxable event? Now, the process of rebalancing is a non-issue as it relates to taxes and 401ks and IRAs and other qualified accounts. However, if a large portion or significant portion of your assets are in taxable brokerage accounts, LLCs, trust accounts, you'll probably have fairly significant capital gains by the time you're approaching retirement. So why pay more taxes than you need to by selling 30, 40% of your equities in a single year? You want to implement that process over multiple years, work with your advisor, work with your CPA so that you're efficiently transitioning from stocks in a very tax efficient manner, rather than potentially putting yourself into a higher tax bracket. And here's some general piece of advice for the process of transitioning to a more conservative portfolio. How do you go about it? Again, waiting until a year before you retire to reduce risk is too late. Again, we show the data on the likelihood of a negative outcome for an all equity portfolio. So start reducing that risk 3 to 5 years, ideally, prior to the need for cash flow or the need to tap into your retirement funds. The way to do that specifically is transitioning from stocks to bonds or cash equivalents, and that will allow your portfolio to minimize volatility, which in turn helps you to limit that sequence of return risk. Because if you can avoid liquidating investments at an inopportune time, then you have put yourself in a position where you're highly likely to have a successful outcome, provided that you've saved adequately for retirement. And the reason that works is because there tends to be an inverse relationship between stocks and bonds. Now, 2022 being the exception, where both stocks and bonds sold off, but history has shown us over and over again when there is stress in the equities market and when stocks are selling off, the demand for bonds increases. And when there's a high demand for an asset, the value of that asset tends to increase in price. So now by having a mix of stocks and bonds, what you've allowed yourself to do is to liquidate an asset that has appreciated while you buy yourself time to allow the equities that have lost value to then recover. And that's a winning strategy, which will allow you to allow your assets to be sustainable for multiple years and frankly, throughout your investment lifetime. Minimizing volatility and sequence of return risk is much more important than maximizing returns. And that was illustrated in the example we showed with Portfolio A and Portfolio B. A higher return doesn't necessarily mean a better outcome when it comes to managing cash flow. And finally, work with a professional advisor to help you to diversify your portfolio in both the pre-retirement years and then as you phase towards retirement. The reason this is important is because Professionals will have the software to stress test your portfolio under a variety of economic scenarios. The professional can determine which assets are correlated, which will and will not move together. So how can volatility be minimized in order to reduce that sequence of return risk? We have the software to assist in that process. So you want to avoid assets that just move in tandem and correlate in the same direction. That is an optimal strategy, is avoiding that process so that you then have a highly successful retirement outcome. So thank you for tuning in today. That concludes today's webinar. And if you have any questions, please reach out to OJM Group. Thank you very much.
OJM is a multidisciplinary wealth management firm. For nearly 2 decades, our firm has helped physicians across the U.S. reduce taxes, protect assets, and achieve their financial goals. OJM Group offers viewers a complimentary consultation where we can answer your questions to see if our firm might be a good fit for your situation. Simply click the button below to schedule your free consultation. We hope to speak with you soon. Thanks for watching.